Let's get to the markets. The futures are pointing to a slightly lower open ahead of the last trading day of the quarter. And joining us right now is Stephanie Link. She's chief investment strategist at Hightower, also a CNBC contributor. And Stephanie, one of the huge stories this morning is that massive gain in Chinese stocks once again this morning, up more than 8% after the big gains we saw last week. You were adding to some of your positions that have exposure to China last week. Which ones are those, and what do you think of what we're seeing this morning?
Yeah, I mean, the China stimulus is the most since COVID, so it's big. There's more they can do. They sound like they want to do more. We got a little bit of different news over the weekend as well, additional stimulus. The issue here in my mind is that this is such an under-owned space, Becky. The outflows in 2023 alone were $30 billion. The stocks trade on average at 10 times forward estimates. And the emerging markets, the weightings from portfolio managers has gone from 35% to 21%. So there's a lot that can happen here in terms of just playing catch up. And by the way, I would say that if money comes out of India, because India has been the beneficiary of the problems in China, if money comes out of India, I would be buying India as a long-term buy. But China, I think, is a short-term to medium-term trade. And the names that I have been buying, Freeport-McMoRan, I have owned that in the past. I thought that's like the poster child for China. Las Vegas Sands, which is still down 2% on the year, and ExxonMobil.
Wow. ExxonMobil, explain China exposure there.
Well, I just think that the energy prices are down, Becky, because a lot of it is because China demand has been very soft. And so you have to keep in mind that with the big major oil companies, they mint money at $30 oil. So at $70 oil, the free cash flow is substantial. Now, Exxon has done very well this year relative to the other names in the sector. It's up 15% year to date. But I do think at 14 times forward estimates, a very diverse revenue mix, and I like the Pioneer acquisition. And I think, by the way, there's a catalyst here. December 11th, they're having an analyst day, and we're going to learn more about Pioneer and how synergistic it will be. I think it's going to be something like $2 billion per year after the first year of its closing through the decade. So I like the tailwinds there.
And Las Vegas Sands, of course, that's their exposure to Chinese gambling markets. Yeah. You don't buy directly any Chinese stocks, because we had David Tepper on, and he was basically saying buy everything in China. He's been buying Alibaba and everything else he can get his hands on. But you like the exposure through the U.S. markets?
I do. I like the transparency better. You could do all the fundamental analysis in Chinese companies, and then you wake up and the government decides to pull a Jack Ma on your hands, right? So it's, to me, I don't want to say safer, but I think it's just more transparent, more liquid way to get the exposure. As I mentioned, I mean, like Freeport is definitely the poster child for China, for sure. But so is Las Vegas Sands. I mean, they have 63% of their revenues are tied to Macau. And the problem with Las Vegas Sands has been that they are renovating all of their properties in, not all of them, but most of them, in Macau. And so they've been losing market share. And that spend, that renovation cycle ends in the first quarter of 2025. So I want to be ahead of the ending of the spend, because I do think you're going to see better free cash flow margins, and they'll get that market share back. In the meantime, if 37% of their revenues are... Yeah, in the meantime, 37% of their revenues are in Singapore, and they've been seeing double-digit growth there. So I like it. Very cheap stock, too.